Now, before we shift to the U.S. a bit more, I just want to remind you, please like, share, subscribe. Your comments are appreciated. And if you could put a comment on things you'd like to see more of, less of, to speed up some of the shows, maybe make it a bit more focused on what you'd like to hear more about, please let us know, because your feedback just helps make the show better in general. So just kicking off, just looking at GDP, where we sit overall. We'll go through GDP at the end of this. But the New York Fed Weekly Economic Index, is moved that back down. It moved to down 2.2%. So you can see how we kind of peaked and we're starting to roll over a bit. But again, just some of the data points, we're going to find some support, and we expect some of that future weekly economic index kind of flattening out here and actually turning up. It'll still be negative, but a bit more positive than where it currently sits, as that industrial production is going to continue to push higher in general, helping provide some of that support when we're looking at both employment, and manufacturing, as the PMI data is showing you manufacturing is increasing, new orders increased. So again, that industrial production will push higher, which will help support some of those weekly economic leading indicators that the New York Fed is picking up. But when we look at rapid degrossing, and this is a term that I've used a significant amount, and some people are like, what does degrossing mean? Like, what is that? And degrossing means you're just taking down your total book value. So when you look at the market, you had some crazy moves where guys are like, look, I need to just take down, whether I'm winning, losing, which just means I'm going to sell my longs, I'm going to cover my shorts, and I'm just going to take some money out of the market in general, because I don't like the swings, I don't like what I'm seeing, and I just want to shrink and get more focused in terms of where I can redeploy capital. And that's what is meant by just degrossing in general. And we saw that really across, on a global flows across all strategies. You can see that we had a very large degrossing event, which was, stimulated by or kicked off by GameStop. But it wasn't just GameStop. There was other things that were happening that just caused people to shrink their exposures and just avoid some of that volatility that we saw. Now, when we think about the volatility, well, you have more and more call options on the retail trading side. So when we look at small call trade premiums for 4-week rolling sum going back to 2000, you can see just the use of leverage has just exploded over a very short time period, which again is creating these rapid swings that we're seeing in the market as we come to option expiration. We see people trying to leverage their money, and then as their leverage dries up, then they have to sell or because they have margin calls. These are things that are impacting just how people are positioned and how wild some of these moves are, which is why we saw that degrossing event. And then when we look at just where are people positioned on the dollar, because the US dollar continues to be one of the favorite short positions. And this is looking at asset managers implied USD net position. You can see that it's very, very negative on just where things are on that asset manager's USD net long. Excuse me, and this is across or against on a slew of different currencies, and you can see that people are still very short US dollars. And now leverage funds implied USD net position. Again, on a leverage level, people are very short the US dollar setup, which is why it's something to watch, because you could get a shock to the upside, more because it's just people are going to take off that position for different reasons. Because right now, the DXY is at 91.15. We've seen it rally from below 90, but yet as it rallied, we still had oil rallying. We still had equities net rallying. So again, there's going to be, where does that backdrop happen? Do we have to see the US dollar spike to 92 before we see some of that pare back? That's going to be one to watch as we start to see some of this friction, as a lot of people are very short US dollar versus their other positions, because USD is the favorite short side of many macro trades. And this is just looking at the net. So it's taking everything that we've seen, looking at non-commercial asset managers and leverage funds, and you can see that there is nobody that is net long the dollar. And that has been the case since, let's call it July of last year. And it's only continued to get shorter and shorter. So at some point, people will take the trade-off. You'll see some lightening up. It's just going to be tough to see this trade get pressured. Now, when you look at some of the funds here, you can stay net short in general just based on what your carry trade is. The carry trade is still positive to sell dollars, go abroad. So again, there's some functional move between being short USD. It's just when you start to see that unwind, when you start to see some of these friction points, this can snap violently just because there's so many people with the same short position. And given this market is much, much bigger than GameStop, but you've seen what short positions can do. You can see what happens when the incremental buyer is just rushing to cover. So there is something, again, this market is measured in trillions, not even millions or billions. So again, there's a lot more to move this market. But we have seen sharp moves as we saw in 2018, as we've seen in early 2020. Again, these are things to consider when you're looking at what is the positioning in general. So when we look at those U.S. data points, things are flat. There's not much movement in one direction as COVID cases have slowed. Lockdown indexes are starting to get a bit more lenient. But again, you're still seeing job postings are a bit weaker. They're flatlining a bit but they're still not getting to where they need to be to see that gap closed. Airline passengers, just restaurant bookings, just general activity still remains a problem in the underlying on that high frequency data points. And if you look at just the Chapter 11 filings, so January had that slowdown, which we have talked about, where January was going to be a bit slow. You had that push to do it in 2020. March is where we think we're going to see another tick higher as we have a fairly large amount of bonds coming due. Can people roll? Are they going to get stuck in general? So again, these are things that we think are going to become a bigger problem on the underlying economic can really get pulled to the economic forefront of U.S. data points as we start to see some of the pressure. And we'll talk about in the third segment a bit about the local and the small businesses and how the pressure continues to get ratcheted up there. So this is just summarizing ISM Manufacturing Index, Conference Board Consumer Confidence, and you can just see how bifurcated we have the conference board the consumer confidence versus the ISM manufacturing. So ISM manufacturing continuing to surge higher. Here you can see the consumer confidence going lower, and just based on where we've seen, especially in 2008, you can see that the consumer got concerned before we got that manufacturing drop. Now, just based on what we're seeing, manufacturing will continue to go higher. We think that the consumer confidence will turn a bit, but they will merge in the middle somewhere. And it's going to be an interesting time to see where those merge and how the market reacts to it. But when we look at, again, it's not in the third segment. It's in this segment. We'll talk about it. But when you just look at some of the activity, as we keep talking about, the activity in the U.S. is just, again, moving sideways. There's really not much that we're seeing in general in terms of just global movements where everything is just steady as she goes, down, call it, 25% from last year. So we're not seeing this pickup, which is why we're seeing it in pockets. There are pockets of growth, but we're not seeing the net value increase, which again leads to the pressure in refined products, the pressure in oil, and the pressure on some of the economic data points on a global level, even though we do have some fairly strong leading indicators in areas, even once you back out some of the logistical issues. And that leads to what we're seeing on this wealth effect. So when we think about the wealth effect in the U.S., you have to consider what is happening on a year-over-year change in nominal PCE, or that personal wealth effect comparison. So when we think about people seeing their increases in home prices, they're seeing this support as home prices go to new all-time highs on an aggregate level to about $340,000, and that's using all of the U.S. Obviously, other cities are more expensive. You're seeing people have that net wealth effect, and they're borrowing against it, or they're trying to realize lock in some of the benefits. And this is obviously reversing from 2020 as you see some of these benefits coming into 2021. But when you talk to or look at the data, individuals are looking to save more and not spend as much. So how much of this will actually get pushed into the system? It's going to be interesting to see in general as we see some differentiating opinions as to what the consumer is going to do. And that's when we, again, looking at that record wealth effect, and when we look at that real estate continues to be a big part of it, but so does the equity valuation. And again, when you look at what the equity market has done, people's inherent portfolios have been helped by both real estate and equity as we continue to move higher. So how much of that can stay when we start looking at inflation? Like, some of the data coming out where lumber just went limit up, which just means it went to the exchange limit, which was set at $889. As we continue to see these inflationary moves, obviously real estate is a great protection against inflation, but there's going to start to get more and more pressure on how these bubbles can be inflated further and how can you keep them inflated as the smaller and smaller individual continues to struggle across the board. And that's when we start to look at, again, the PC, the personal consumption expenditure core price. You can see that spike. So December PC inflation was 1.3% year over year. The estimate was 1.2%. Again, there's something positive within that, but it's still down from the prior month. So you're starting to see a little bit of it come out, but just based on where inherent capacity is, you're still going to see that net wealth effect, and it's just going to impact people differently, where you're not seeing it in the lower quartiles. Even if you break it into the 5 quartiles, the top 2 are seeing it, but the bottom 3 aren't. Again, that social immobility, that inequality that continues to get extended, because you have to own equities, you have to own real estate to recognize or realize any type of this movement that we've already seen in the market. Which is where when we're looking at, okay, the PC of services, of goods, of business equipment spending. So you're seeing business equipment spending going up, home offices, people trying to do more remote, and that's going to pull up the good side. But services continue to be fairly weak when we consider of where we were, and that's showing up in the PMI data, not just in the U.S., but also on a global level. Now, the U.S. services data came in a little bit stronger than expected, but in Europe and Asia, it's coming in weaker. So again, it's coming to these different components of which is going to drive the most going forward. And this, just looking at the PC on service and goods, will be a net overhang as we head into the new year, or as we continue through the new year. So then when we look at consumer growth, is still significant, but again, it's slowing because consumer electronics, how many times can you buy a television or healthcare equipment? If you buy a Peloton, a treadmill, when you look at household personal furnishings, household appliances, you had people bought homes. You had a record amount of people moving from urban to suburban, so you had more space. You went from living in 1,000 or 1,200 square foot apartment to living in a 2,500 square foot house that requires stuff, and you could go buy stuff. And again, these are things that we think are going to continue to roll over, still remain strong year over year, but again, starting to kind of normalize, and we're not going to see the same type of impacts on GDP as we did before, which comes to, again, that full cycle of, well, how much of that PCE is going to see its way into the market in general. And that's when we start looking at loans and the appraisal waiver. So when we think of the appraisal waiver, it's, I got dinged back in 2013 when we bought our home, where they said that our house didn't appraise, even though now it's well above where they originally appraised it and where we bought it. But it's just a matter of, well, they're saying you don't need that appraisal. We'll still give it to you, even if you're looking to just either refinance. So if you look at purchasing outright, you're seeing that you obviously still need, that's where you're going to have the biggest amount of making sure that you have an appraisal on the GSE loans. But on a cash out or a no cash out, when you're thinking about refinancing your mortgage, they're saying, no, it's fine. Like, we see the numbers, we see what you're paying taxes on. They've all been revised up. So clearly, if you are taking, especially no cash out, you're just looking to refinance to a lower rate, there's a lot of times that this is being waived. Now, when we look at Freddie, Fannie, and GSE combined, the upward trend in the share of appraisal waivers slowed this month, although Fannie's share remained at 44%. And this is, again, when we're thinking about those smaller homes and just look at the increase in the use of cash out waivers since January 2020, 230%, increase in the use of waivers on all loan types, up 139%. We know how this all ends, but again, these are things to consider when you look at where we were in previously. Again, we continue to push to all-time highs as money is free, rates go down, and you continue to see people using this money to buy homes, trying to lock in some of that increase in the equity value, in the real estate value. And here's kind of that perfect example of where you're seeing those waivers, and it's much easier to get that capital. But when we look at that ISM manufacturing PMI, you paired back a little bit. We're back to 58.7. We're back positive in the employment side of 52.6. So back to the expansionary, but you can see that it's waffled up and down based on where we are. And now the trajectory is a little bit higher. So not that we're going to pare back, but we think that on the employment side, we're going to hang sideways and we're going to see some expansion starting to come through. ADP data showed a surprise to the estimates. Estimates were for, I think it was about 70,000. It came in at about 170,000. So those are things that are a net benefit in terms of where things look on the employment side. And we'll get more of that data tomorrow when we get some of the final numbers coming into on not just weekly, but also the monthly data. And now just pulling in, again, just to make sure, ADP employment was expected to be at 70. We came in at 174,000. So then when we think on where is that going to be for non-farm productivity, where we continuing claims, and then when we go to Friday, when we look at change in private payrolls, manufacturing payrolls, ADP is telling you that those should be pretty good. So that's going to be a positive, and again, supporting us at these employment levels, given the fact that this is a bit more of a leading indicator. But it's important to look at what is driving the number. And the new orders had a pretty big pareback, still expansionary, but still slowing. Headline slowed a bit. Again, new orders and production index are starting to shift down, which is just saying that we're in expansion, but the expansion is starting to find some stability at these levels, coming back to not seeing too much turnaround from where we currently sit on activity. And when we look at the industrial production versus ISM manufacturing, so industrial production, as coming back to what we said at the very beginning, that's going to snap back to the top, and we should see that start to recover, which just means that industrial production will see that that benefit, and that'll support some of the economic activity that we've seen. But the biggest contributor, again, to that ISM manufacturing remains the supplier deliveries, which is a net negative when you think about where we sit. Now, if you factor in everything else, we're still at that 55%, and it's still a net positive. So even if we started to see some of that supply deliveries normalize a bit, we'd still be in expansionary territory, which again is going to support this industrial production. Employment continues to be slow, but production, new orders, even though new orders pared back, they still remain expansionary. Again, all of these are net positives in general. But as we get inventories building up a bit, and that'll help buffer some of the supply side, so then you can wait for the rail cars instead of the trucks. Trucks delivering 1 or 2 at a time, rail delivering 100 to 150 at a time. Again, you're starting to see some of those differences in general. And that's where we go a bit deeper into, again, that market services PMI, which surprised the upside of 58.3 versus an estimate of 57.4. So when we look at business activity, fell slightly, again, fell to about 59.9, but it's still expansionary, down from 60. New orders on the service side had an increase to 61.8, a positive. Employment rose to 55.2 from 48.7, again, back into expansionary. But we're seeing some of this waffling back and forth, so we need to see that stick. Inventory changes have fallen, supplier deliveries have fallen, but the bigger side is prices paid fell, but it fell from 64.4 to 64.2. So again, you're still in this massively expansionary inflationary cycle. But then when we look at backlog of orders, we went from rose to 50.9 from 48.7. So we're into slightly expansionary, but then new export orders fell to 47 from 57. So you're getting some of this lumpiness in general, where imports rose to 53.5. Inventory sentiment is starting to get a bit better at 49.7. So you're starting to see some of this, again, this flatlining of data points, where some is really good, some of it is kind of flattish, and then some of it is like a little bit weaker. But again, net positive, but it's starting to show that we're just starting to get into a bit more of a grind. Now, this is one that we wanted to call out as ISM prices paid. So the survey was for 76, came in at 82.1. Again, this is where that inflation comes through. This is where you see those prices exploding and taking out those 2018 highs, even though we don't have wages of 2018 highs, and we continue to see pain in terms of the amount of people unemployed, wages, shrinkage. Again, these are things that are weighing on just what we think the future of Q1 could really look like. And this is the one to watch when we think of paid. And then when we think about, well, what are people doing with it? Well, let's look at the PPP. And you could see that PPP loans covered 3.8 weeks of small business expenses. This is a problem, because when you think about what is the next wave of PPP loans going to do, we're just not seeing that really go all that far, given that they continue to struggle, which we'll go through in more detail in segment 3. And that's why when we look at US GDP, the year over year, the annual year over year was down 3.5%. It's the lowest that it's been since the 40s, taking out the low that we saw during the financial crisis. So the question is going to be, how quickly can we rebound? And we think it's going to be a bit slower from expectations as we go forward. And when we look at personal consumption, the survey was for 3.1%. It came in at 2.5%. Again, this is where we struggle with what is personal consumption going to do, and how is that going to speed or get pressured into Q1. And if you have inflation going up and you have what people are actually spending money on going up, you can consume, you consume less because your money doesn't go as far. So even though you're getting money into your pocket, you're not going to see the same type of ability, because in March and April, we were in a deflationary cycle. We had all these prices going lower. Now we're in the opposite, and you're just not going to see that money going to the same level. And that's where we start to see the real GDP growth cooled. What it actually came into versus Q1, Q2, Q3. Obviously, Q4 came in positive of 4%, which was below expectations of 4.3%. Again, finishing out the year on a net negative, as we showed earlier. And what was the difference? And here you can see the difference versus pre-COVID in general. Consumer spending is the biggest one, because obviously durables were strong, but we don't think durables is going to continue as we saw from Q3 into Q4. When we look at non-durables, that's slowing down a bit. Services remain under pressure now that things have normalized. Fixed investment, we're seeing that bifurcation where, residential building is continuing, non-residential is slowing considerably. So you're getting, again, that K-shaped recovery. And, exports are struggling. Imports are flattish in general in terms of where they were because Q4. But again, these are things that we're seeing where there's not a lot of follow through that we see in Q1, which is going to lead to some of those expectations being reworked lower. And just looking at that in a different way is, where are things going to go on the government spending side? Because government spending was down year over year by about 0.6%, but that's something that we don't see changing too much, because it's the state and local that we're just not seeing. They don't have the tax revenue to really try to juice that. We should see some non-defense increases just based on what will most likely pass on the Democratic bill versus the Republican. So this is something that will provide some uplift. But the consumer is the one that we look at the most, that we think is going to have the most bifurcation in terms of how much of that is going to continue now that we're seeing a slight pickup in employment, but really nothing meaningful. And when we think about meaningful, this is when we look at, okay, well, where's the U.S. money supply versus GDP? So you can see that the money supply has increased exponentially while the GDP has really done nothing. And again, the law of diminishing returns is real. You're having this money fight back and forth between a very finite area, between the bank and the Fed, and you're not seeing that movement into the market. And when you think about GDP increases, you're not seeing that employment respond, and you're seeing the GDP year over year kind of flatline, just as you're seeing employment flatline. And that's why, when we look at previous cycles, employment extends to the downside, not surprising. But now we see more investment in technology. You're seeing less people getting hired back. This is something that we don't think is going to readily change. As we said at the very beginning of COVID, if you let go 100 people, you were going to hire back 20 by the end of last year. And then by the time this is all done, you'll hire back another 30. But you hired back 50, but you let 100 go. And that's what we think is representing, I think, fairly well. If you look at actually the delta, that's really where we see some of this flatlining, and we just don't see the same type of turnaround on the employment side, which again is going to weigh on wages and just how much activity can we see in the underlying U.S. consumer, and really the U.S. consumer being 75% of spending, how much of that can be driven further up from where it currently is.